The paperwork felt routine the afternoon we signed to reset the mortgage back to 30 years. The rate was lower than what we had been paying. The monthly number on the disclosure page was smaller. The loan officer spoke in a steady voice, sliding each page across the desk, pointing where to initial. Nothing about it felt reckless. It felt organized. It felt like something adults with children and responsibilities were supposed to do when an opportunity presented itself. We had already lived in the house for 8 years by then. The original mortgage had been a 30-year loan too. We had chipped away at it slowly, one payment at a time. There were years when we added a little extra to principal, years when we could not. The balance had gone down, not dramatically, but in a way that felt measurable. When we logged into the account, the number owed no longer matched the number on the original closing documents. That had felt like progress. Refinancing seemed like a continuation of that same progress. The rate drop meant hundreds less each month. The closing costs were folded into the new loan. We told ourselves we were being efficient. The children were in elementary school. Childcare had shifted into after school programs and summer camps. Groceries were more expensive than they used to be. Insurance premiums had crept up. A lower mortgage payment created room. Room for braces later. Room for sports fees. Room for replacing the aging car. We did not describe it as starting over, but the amortization schedule did not share our language. It reset quietly, like a clock that had been wound back without noise. The new loan was again stretched across 30 years. The principal balance, padded slightly by closing costs, became the foundation for another long arc of interest. In the first year after refinancing, the monthly relief felt tangible. The checking account stayed above the minimum buffer more consistently. We stopped transferring small amounts from savings at the end of certain months. The house no longer felt like a financial weight pressing on everything else. It felt manageable again. Friends said we were smart to take advantage of lower rates. News coverage framed refinancing as a responsible move for homeowners. We were not pulling cash out. We were not upgrading the kitchen. We were simply adjusting the terms. The phrase used most often was lowering the payment. It sounded disciplined. The years moved forward. The children grew into middle school. The house aged in less visible ways. The water heater failed one winter. The roof required partial repair after a storm. Property taxes rose as assessed values increased across the county. Homeowners insurance adjusted upward each renewal cycle. The mortgage payment itself stayed stable, but the total monthly housing cost did not. Because the loan had reset, the early payments were again weighted toward interest. The statements showed it clearly. A large portion went to the lender, a smaller portion nudged the principal downward. We noticed, briefly, in the first few months. Then the statements became background again, like utility bills. Around year 6 of the new loan, we realized we had lived in the house for nearly 15 years total. 15 years of mowing the same yard. 15 years of seasonal decorations packed and unpacked. 15 years of writing the same address on forms. It sounded substantial when said out loud. The mortgage, however, reflected something different. We were 6 years into a 30-year term. The principal balance was lower than at refinancing, but not dramatically lower than where we had been before we reset it. If we had kept the original loan, we would have been more than halfway through by then. That comparison did not come during a crisis. It surfaced one quiet Sunday afternoon while organizing old paperwork. The original closing documents were in a folder at the back of a drawer. The interest rate looked high compared to the refinance rate. The monthly payment looked larger. But the remaining term at the moment we refinanced had been 22 years, not 30. We had traded 22 years for 30. At the time, 22 had felt long. 30 felt normal because that was the standard term everyone referenced. It blended into the language of adulthood. 30-year mortgage, 30-year loan, fixed rate. Familiar phrases can make extended timelines feel ordinary. As high school approached for our oldest, other financial realities took shape. College visits required flights and hotel stays. Application fees added up quietly. Savings accounts we had opened years earlier did not feel as full as we once imagined they would. The mortgage payment remained lower than it would have been under the original loan, but the loan itself stretched forward well past the years we once pictured being free of it. There was no single moment of regret. Instead, there was an accumulation of awareness. The refinance had provided short term flexibility. That flexibility had been used, not wasted. It absorbed higher living costs. It allowed us to avoid credit card balances in certain tight stretches. It created breathing room during a period when both our careers felt uncertain. Those outcomes were real. But the extended interest timeline was also real. As the children left for college one by one, the house grew quieter. Bedrooms that once held bunk beds and scattered homework became guest rooms. The grocery bill decreased. The calendar cleared. We were older by then, in our early 50s, still making monthly payments on a loan that had begun almost 2 decades earlier and been reset halfway through. The balance was lower, steadily declining. Yet, the final payoff date set far enough in the future that it intersected with traditional retirement age. That alignment had not been obvious during refinancing. At that time, retirement felt abstract. The immediate monthly savings felt concrete. Work in our 50s carried a different texture than work in our 30s. Energy levels shifted subtly. Corporate restructurings happened more frequently. Younger managers appeared. The mortgage payment, even at the refinanced lower rate, was still due each month, without adjustment for age or fatigue. Some peers had chosen shorter refinance terms when rates dropped. 15-year loans with higher monthly payments but accelerated payoff schedules. We had not considered that seriously at the time. The priority had been reducing the monthly obligation, not increasing it. Our decision matched our life stage then. Children at home, expenses layered on top of each other, income steady but not guaranteed. By year 15 of the refinance loan, we had paid interest for 23 years total when combining both mortgages. The house itself showed signs of long occupancy. Cabinets worn at the edges. Hardwood floors dulled in high traffic areas. Appliances replaced one at a time. The structure had provided stability. It had anchored birthdays, illnesses, late night conversations at the kitchen table. Financially, the house had also accumulated layers. Property taxes had nearly doubled from our first year. Insurance premiums reflected a more expensive rebuilding cost. Maintenance expenses averaged higher annually than in the early years. The mortgage, though fixed rate, existed within a broader housing cost ecosystem that did not remain fixed. There were months when we looked at the statement and calculated how much total interest would be paid if we followed the schedule exactly. The number was large, larger than the original loan's projected total interest, even with the lower rate, because of the extended timeline and the reset of early interest-heavy years. We did not speak about it often. It did not dominate dinner conversations. It sat in the background, part of the financial architecture of our lives. In our late 50s, conversations about retirement accounts became more frequent. Colleagues discussed target dates. Some announced plans to downsize. Others planned to relocate closer to adult children. The idea of carrying a mortgage into retirement felt heavier than it had a decade earlier. Selling the house was considered, briefly. Real estate values had appreciated. Equity existed. But selling meant transaction costs, moving expenses, and the emotional process of leaving a place layered with memory. It also meant re entering a housing market with higher prices and potentially higher interest rates than our refinanced loan. Staying meant continuing the payments. The refinance decision, made in our 40s, had quietly shaped the financial texture of our late 50s. Not dramatically, not catastrophically, just persistently. There were no missed payments, no defaults. The choice had not derailed our finances, it had simply extended them. The final years of the mortgage overlapped with part time work arrangements. Income patterns shifted from steady salaries to a mix of consulting and reduced hours. The fixed mortgage payment, once a smaller percentage of our take home pay after refinancing, now represented a larger share of more variable income. Each payment felt familiar: automatic withdrawal, a line item in the monthly budget. The principal portion finally dominated the interest portion in those later years. The amortization schedule, once tilted heavily toward the lender, now leaned more in our favor. It had taken decades to reach that point. On demand, the balance dropped below five figures. There was a quiet acknowledgement. Not celebration exactly, more like recognition of duration. The loan had outlasted multiple cars, several supervisors, two family dogs, and the daily presence of our children in the house. When the final payment posted, there was no dramatic shift in lifestyle. The house still required maintenance. Taxes and insurance remained. Utilities continued. But the absence of the mortgage payment altered the monthly cash flow in a way that felt noticeable. A line item that had been constant for most of adult life disappeared. Looking back through old files, the refinance documents remained crisp compared to the faded original closing papers. Two sets of signatures, years apart, both made in good faith. Both aligned with the information and priorities present at the time. The lower rate had saved money relative to keeping the higher rate. That arithmetic was straightforward. Yet, the reset to 30 years had extended the period over which interest accumulated. The total interest paid across both loans exceeded what we once imagined when first buying the house. Neither decision had felt irresponsible when made. The refinance had been described as prudent. It had been common. It had been supported by prevailing economic conditions and advice circulating widely among homeowners. What unfolded afterward was not dramatic enough to attract attention. It was incremental. A slightly longer horizon, a slightly slower path to outright ownership. A mortgage that quietly accompanied us further into middle age than originally planned. The house itself remained steady through it all. Seasons passed across the same windows. Snow collected along the same fence line each winter. The mailbox held decades of statements, renewal notices, and occasional refinance offers from other lenders, even after we had already reset once. The financial system around us continued to evolve. Rates rose and fell again. Younger homeowners repeated similar refinancing cycles. The language in advertisements remained consistent: lower your payment, reduce your rate, take control of your finances. We understood that language. We had lived inside it. In retirement, with the mortgage finally gone, the house felt different. Not because its walls changed, but because the obligation attached to it had ended. The years of paying interest had already played out. They could not be restructured retroactively. They existed as a long sequence of automatic drafts across decades. Sometimes, when discussing finances with peers, the topic of refinancing surfaced casually. Stories varied. Some had shortened their terms and finished earlier. Others had refinanced multiple times, extending further with each reset. Each path carried its own arithmetic. Our path was simple: one original 30-year mortgage, one refinance back to 30 years after 8 years, 38 years of payments on the same property before full ownership without a lien. The refinance had not felt like adding 8 years. It had felt like lowering a number on a monthly statement. The extension revealed itself only gradually as calendar pages turned. The children, now adults with their own housing decisions, spoke about interest rates and affordability in a different market. They referenced our experience occasionally, not as caution or endorsement, just as part of family history. The house stood as evidence of endurance more than strategy. The lawn still needed mowing. The gutters still filled with leaves each fall. The roof, replaced once more near the end, carried shingles that would likely outlast our time in the home. Ownership without a mortgage did not freeze time. It simply removed one recurring transfer of money. The refinance documents remained stored with the originals. Two chapters of the same financial story. The signatures were steady on both sets of pages. The intentions had been practical. The outcomes unfolded across decades, measured less in dramatic events and more in the steady passage of payments. The decision had seemed sensible. In many ways, it had been. It provided relief when relief was useful. It created flexibility during expensive years of raising children. It aligned with what many households around us were doing. It also lengthened the timeline of obligation in a way that was not immediately visible. By the time the final payment cleared, the refinance itself felt distant, almost abstract. Yet its effects were embedded in the chronology of our adulthood. The house had been financed longer than we once pictured. Interest had been paid longer than originally scheduled. Work had been extended in subtle ways to support that continuity. Nothing about it was dramatic. No crisis, no sudden loss. Just a recalibration that rippled quietly through years that followed. The afternoon we signed the refinance documents, the office lighting was bright and neutral. The stack of papers was thick but manageable. The rate looked good. The payment looked better. We left believing we had improved our situation. In many ways, we had. The longer arc of what that improvement meant only became clear much later, when the decades attached to that decision were already behind us.